So good afternoon, everyone. I hope you're keeping well and safe. My name is Claire Davey. I'm Head of PAYE and Personal Tax Compliance in KPMG Ireland. And on behalf of KPMG, I'd like to welcome you all today to our latest webinar in our Lunch and Learn series. Our topic today, Employment Tax in a Changing World, follows on from some of our previous webinars, where we discussed a variety of COVID and non-COVID related domestic and expatriate employment tax matters. The purpose of today's webinar is to bring you up to date on the latest developments and, importantly, where things are headed in the area in the post-COVID environment. No doubt more changes will emerge over the coming weeks as the government announced the detail of Budget 2022, and we will, of course, keep you appraised of these developments as and when they are announced. So be sure to keep an eye on our Budget 2022 homepage for regular updates and, of course, our KPMG insights. But today, I'm delighted to be joined by two of my colleagues, Andrew Egan, a tax director in our tax transformation and technology team, and Michael Grace, an associate director in our people services tax practice. Andrew and Michael, our presenters today, have a vast amount of experience advising clients on a range of employment tax matters, including how businesses can use technology to meet their PAYE obligations. So what's on the agenda for today? Well, firstly, I'm going to spend a couple of minutes on the modernisation of the PAYE system, a highly topical area at the moment and a key area of revenue focus. Michael will then bring you up to date on the latest developments and also what you can expect to see in the area in the not so distant future. And finally, Andrew will provide a brief compliance update on employment tax yield and e-audit trends, and will also share some insights on his recent revenue audit experience. So all topics are particularly pertinent at this time, and we do hope you'll be able to gain a couple of nuggets which will help you in your business. If you have any questions today, we'd be delighted to hear from you. So please feel free to direct your questions to our panelists using the Q&A function at the bottom of your screen. We do have time allocated at the end for questions, but similar to previous webinar formats, if we don't have time to answer them all, we'll respond to you directly after the event. And lastly, today's session is being recorded, so a link together with a copy of the slide deck will be shared with all participants shortly after the webinar. So with that, let's kick off. So what have the changes to the PAYE system actually meant for employers in practice? Well, a couple of key points to note here in relation to the impact of the changes. Firstly, there's no doubt real-time reporting has fundamentally changed the PAYE landscape and the way employers now interact with revenue. In a nutshell, real-time reporting requires employers to provide a detailed breakdown of payments, deductions, and taxes for all employees on or before the payment date. And this was a major change for employers, as historically, similar information was only made available to revenue after the year end. And as a result, many employers will have had to undergo significant process change to meet these new requirements. Secondly, the introduction of real-time reporting has not only seen more stringent reporting requirements, but the revised PAYE regulations and updates to the Code of Practice have given revenue wider opportunities to identify exposure areas and also penalise employers for non-compliance. Thirdly, while real-time reporting was introduced with the aim to make the payroll reporting process more efficient, and revenue have largely been successful in achieving this main aim with the move to a more instantaneous PAYE system, the reality is employers are now providing much more information to revenue than they would have historically, and revenue can now easily identify payroll irregularities which would otherwise have been more difficult under the previous system. And finally, unsurprisingly, revenue audits and interventions are benefiting from this increased data capture under real-time reporting, with revenue now able to identify data trends and anomalies based on payroll uploads, which is resulting in more targeted and focused PAYE interventions. So in summary, I think it's clear, and as you'll hear from Andrew shortly, Revenue's newly modernised digital platform is proving quite a powerful tool and has become a significant asset to the Irish revenue. So moving on now to touch on PAYE compliance more generally, and in particular, where we are now with real-time reporting and what direction things are moving. Well, firstly, I think it's fair to say PAYE system has gone through incredible change over the past few years, and real-time reporting has completely raised the bar in terms of PAYE compliance. And with employers now operating in an environment of increased revenue audit activity and one where more data is being captured and shared, it's clear more is now expected of employers in the way they manage their compliance obligations. Secondly, the onset of the COVID pandemic has added further complexity to the compliance process, particularly in relation to global mobility tax matters, where we've seen a significant increase in cross-border remote working and, of course, displacement of employees. And the correct operation of PAYE is a key part in managing these employee movements. Thirdly, in terms of revenue's approach to non-compliance with real-time reporting, we've definitely seen a difference in approach over the last 2 years. In 2019, much of the focus was on the successful implementation of real-time reporting, and revenue were quite lenient as a result. But 2 years on, it's clear revenue now fully expect employers to grasp the new rules and be compliant. And as we move through 2021, we're seeing a lot of anecdotal evidence to suggest a harder line approach is now being taken by revenue. So, for example, leveraging new technology with a view to interrogating data is a key component of revenue's compliance strategy, and raising real-time reporting compliance is high on the agenda. Number 2, revenue's compliance checks on the COVID income support schemes, TWSS and EWSS, are by extension focusing on identified compliance issues in relation to the operation of real-time reporting more generally. 3, while formal revenue audits were particularly lacking in 2019 and 2020, we did see a rise in revenue aspect queries, focusing not only on the usual off-payroll matters, but also employers' adherence to the real-time reporting regulations. And finally, we are seeing a re-emergence of revenue audit activity in 2021, and for the first time ever, real-time 2021 PAYE e-audits. And again, similar to the trend we're seeing in relation to revenue aspect queries, not only focusing on employers' PAYE application, but also their adherence to the real-time reporting rules in general. So in summary, I think it's clear revenue's visibility in this area is at an all-time high. And in practice, we are seeing more costly PAYE settlements as a result. So moving on now to touch on some of the key challenges employers continue to face in reporting PAYE under the new system. So while many employers impacted by the changes seamlessly transitioned to the new system and have good processes and procedures in place for regular pay items, the main challenges we're seeing in practice relate to the timely reporting of non-core pay items, which before the new system allowed for some degree of retrospective reporting without penalty. And given it can be quite common for payroll teams to experience delays in obtaining accurate and complete information when it comes to, say, taxable benefits and expenses, these are the areas which tend to be most challenging in practice for employers. So, for example, company cars require constant review to ensure the correct BIK is calculated and reported. Share-based remuneration can take a great deal of time and effort to determine the precise taxable value. And of course, in relation to inbound assignees who have a shadow payroll requirement, data is often gathered from various sources. And while it is still necessary for benefits in kind and shadow payrolls to comply with real-time reporting rules, helpfully, employers can use the best estimate in the first instance with a correction for actual in the next payroll submission. And in the case of company cars, BIKs can be adjusted for on a quarterly basis. But regardless of these relaxations, the pressure to meet real-time reporting in such circumstances can be significant, and the whole area of BIKs, taxable expenses and expatriate issues tends to be a high-risk, labour-intensive challenge for employers, particularly where information is dispersed throughout the business, leading to increased compliance risk as a result. So with this in mind and the heightened revenue focus in this area at this time, moving on now to touch on some key actions employers may wish to consider to ensure a high degree of compliance with real-time reporting going forward. So as mentioned earlier, many employers will have undergone a complete overhaul of existing processes and procedures when real-time was first introduced. But given the progressive nature, of course, of employment taxes and the many challenges brought about by COVID, now is an ideal time for employers to consider undertaking a self-review of real-time reporting administration to date. So, for example, review and test your existing PAYE controls to ensure they're robust, effective and have been adhered to, and then consider any improvements necessary to comply with real-time reporting going forward. To ensure all relevant stakeholders who play a part in the PAYE process are aligned, including HR, finance, payroll and procurement, so that accurate information is flowing to the payroll department in a timely and efficient manner, and then look to address any identified gaps or exposures and take action as appropriate. So whether that's correcting historical issues by way of a PAYE disclosure, tightening up on existing processes or procedures, or establishing new ones, all of this can help to mitigate compliance risk and quite possibly a PAYE intervention. So in summary, timeliness and accuracy of information really is key to ensuring compliance under real-time reporting. And what we often find in practice when carrying out PAYE control reviews, minor tweaks or amendments to existing policies and procedures can be highly effective in helping employers meet their PAYE obligations. And lastly, from a global mobility perspective, for employers who have employees working from home and in different locations, whether that's due to COVID or normal business reasons, there are a number of tax and social security issues that can arise, which extend beyond employment tax to personal tax, PE risk, and even immigration. So with this in mind, my advice to employers is number one, keep an up-to-date record of where your globally mobile employees are located at all times. Number two, be aware of potential reporting gaps and pitfalls that can arise in cross-border scenarios. Number three, look to implement detective controls to help mitigate compliance risk. And finally, future-proof the business by having global mobility policies and procedures so that everyone is aligned and you meet your relevant compliance obligations as and when they arise. So that concludes the key areas I wanted to touch on today in relation to real-time reporting. I'm now going to hand you over to Michael to bring you up to date on the latest employment tax developments. Michael, over to you.
Thanks very much, Claire. Good afternoon, everyone. So today I'm going to briefly run through some recent updates we have seen from Revenue on COVID-19 related concessions, updated guidance issued in respect of POE exclusion orders, the new employer share awards return, and where things currently stand with the employment wage subsidy scheme. Finally, I will also then go through some key future developments to keep an eye out for. So moving on to the COVID-related concessions, as I'm sure all of you are aware, in response to the pandemic, Revenue introduced a number of significant concessions to existing PAYE rules and regulations during 2020. However, many of these concessions have ended from 1 January of this year, and it is important to ensure that your business is still not relying on COVID-19 concessions that are no longer in place. So starting with the good news, the following concessions do remain in force. So firstly, for cases where an employee is doing minimal business travel but still has access to a company car, in calculating the BIK due on this benefit, employers can refer to the mileage undertaken in January 2020 in order to assess what percentage of the original market value to apply. As things hopefully start to return to a new normal, employers should be mindful that they will need to calculate company car BIK in the normal manner and to ensure that processes are in place to determine the point in time from which they can no longer rely on this concession for their employees. Next, Revenue will consider employees working from home as a result of the pandemic to still be regarded as an e-worker, and as such, employers can pay a tax-free allowance of up to $320 per day of remote working, or alternatively, employees can claim a tax-deductible expense with respect to the portion of their utility and internet costs. Next, Revenue has confirmed that if an employer covers the cost of an on-site flu vaccine rollout or reimburses an employee for getting a flu vaccine, this will not be regarded as a taxable BIK. Additionally, if an employer covers the cost of a COVID-19 test for an employee, this will also not be regarded as a taxable BIK. In relation to the small benefit exemption, Revenue are currently allowing employers to give up to 2 non-cash awards to employees during a year, as opposed to the usual 1 per year, where employers wish to provide an award to their employees in recognition of their efforts during the pandemic. It is important to note, however, that the other conditions to claim small benefit exemption must still be met. So, for example, the aggregate value of 2 gifts cannot exceed €500, the gifts must be non-cash in nature or not convertible into cash, and the awarding of the gift must not be a part of a non-qualifying salary sacrifice arrangement. So now moving on to the bad news. Some of the key concessions that are no longer applicable from 1 January of this year are primarily related to cross-border cases. For example, if an individual is exercising a non-Irish employment in the state, there is no longer any relaxation allowed in respect of the operation of Irish PAYE on their Irish workdays, unless they can avail of the short-term business visitor rules. For the case of multi-state workers, that is employees who are employed under a non-Irish contract of employment and they split their time working in Ireland and other countries, Revenue allowed the operation of Irish POE based on their normal working pattern prior to COVID-19. Since 1 January, this is no longer the case, and employers need to assess the level of activity of their multi-state workers in Ireland to ensure not only that the appropriate level of POE is being withheld, but also to ensure that Social Security is being paid in the right jurisdiction. Next, moving on to more administrative matters, the 60-day extension to the deadline for the submission of the Form SARP-1A has been removed. For most of 2020, Revenue did allow companies to file SARP applications for their qualifying employees within 150 days of them arriving in the state to take up their duties. However, from 1 January of this year, the deadline to get the Form SARP in is now back to the original 90 days, and Revenue do strictly enforce this deadline. And then the filing deadline for employer information returns in relation to share-based remuneration is now the usual deadline of 31 March of the following year. So moving outside of COVID-related concessions, Revenue has recently provided additional guidance around the taxation of bonus payments made to employees who temporarily work abroad and their employer has obtained a PAYE exclusion order, or PEO for short. As a quick refresher, if an employee is not tax resident in Ireland and has less than 30 workdays in a tax year, their employer can apply to Revenue to remove the obligation to operate POE on their employment income. Since the introduction of real-time reporting, however, there has been confusion on the PAYE treatment to apply to bonus payments made to employees where a PEO is thrown into the mix. And they've now provided guidance on how to approach the payroll tax treatment of such bonus payments under numerous scenarios. So each scenario does bring its own form of complexity, and it may in fact require separate employment IDs to be created in order to ensure that the bonus payments are processed correctly. So it is important to familiarise yourself with the new requirements or seek advice to ensure compliance. Moving on to the Employer Share Awards return, a key development from earlier this year was the introduction of this return, or the ESA return, as we call it for short. This return does cover the reporting of information on share plans, which until now there was no prescribed format for reporting, for example, in respect of restricted stock units and restricted shares. This new return reporting requirement is now in place from the 2020 tax year onwards. The deadline for the 2020 tax year has just passed, being on the 14th of September, but the deadline for future form ESAs will be 31 March of the following year. So for example, the 2021 ESA filing will be 31st March of next year. So it is important that employers are thinking about this. I know we've just gone through the first cycle, but the next cycle won't be too long coming in March. So now moving on to the Employment Wage Subsidy Scheme. As many of you will be aware, the scheme has been extended to at least 31st December of this year. While the status quo in terms of the operational aspects of the scheme were maintained for Q3 of this year, in terms of the retention of the enhanced subsidy rates and the reduced employer PRSI rate of 0.5%, there were some changes to the eligibility criteria, which did take effect from 1 July of this year. Firstly, from 1 July of this year, the reference period to assess eligibility has changed from 6 months to now 12 months. However, of course, employers must still review their eligibility to claim the EWSS on an ongoing basis at the end of each month. And this is especially pertinent now that as activity is increasing, it is essential employers get the timing right for when to exit the scheme to avoid a scenario where they have to repay any subsidy payments that they shouldn't have claimed. So under these new rules, employers are now generally required to look at their calendar year, i.e. actual results in 2021 to date, plus projected results at the end of the year, and compare this to the same trading period in 2019 in order to assess whether they expect to meet the 30% decline in either turnover or customer orders. Because of this, we are actually seeing that by broadening the period of assessment, this has benefited businesses in maintaining their eligibility to claim the EWSS, especially for those who have had a difficult first half of the year. Secondly, Revenue are now conducting systematic checks to determine if employers are expected to meet the 30% decline test. They will do this by assessing the reasonableness of projected turnover compared to historic performance, and that they will then confirm or reject an employer's eligibility for the scheme in the next pay period. In order for them to do all of this, employers must now submit a monthly employer eligibility form, known as an ERF, which will comprise of two things. Firstly, a declaration confirming that the information provided to claim the EWSS is true and accurate. And secondly, an overview of the data employers were already using to determine their eligibility to continue to claim the EWSS. Now, it's important to note here that you don't have to upload the data that you're using to base your eligibility, but there's more to have a description of it. And it's also important to ensure that you have that documentation on hand should the Revenue ever look for it. So speaking of compliance, compliance interventions, given the significant cost of the scheme, which is currently up to around 5 billion, there's no surprise to any of us that Revenue are engaging in compliance checks to ensure that only eligible employees are availing of the scheme. For example, in addition to the systematic checks and eligibility I just described, they are carrying risk-based checks and also assurance checks. Now, there is a 7-day turnaround time for applying to revenue assurance checks, so employers should keep an eye out on the Ross inbox, as this is where any compliance checks correspondence from Revenue would be sent. Now, if that 7-day deadline is not feasible, Revenue are generally quite amenable to requests for extended time, but we would of course advise that you put such requests in as soon as possible upon receipt of the correspondence. So, taking into account the likely upturn in business over the coming months, it will be important for businesses who are still availing of the EWSS to document the key underlying assumptions underpinning their projections and have appropriate point-in-time documentation at hand to support multiple eligibility reviews when Revenue commence their compliance checks in the USS. This is also be especially important for down the line if you are in a revenue audit scenario a few years from now, to ensure that you have the documents in place to ensure that you can justify your claim for the EWSS at the time. Now, in terms of future developments for the EWS, especially with regard to Q4 for 2021, the Minister for Finance only yesterday announced that the EWSS for the month of October will operate the same as it has been for Q3 of this year. And we do expect further updates on the EWSS beyond October to be announced in the forthcoming budget, including whether it will be extended beyond 2021. We would be hopeful that the scheme will continue in its current form beyond 2021, especially with regard to industries that have been really badly hit by the pandemic, for example, the live entertainment industry. And now moving on to some key future developments to keep a look out for. Now, of course, we will provide further updates as further details emerge, but for now, employees should be aware of these key updates in these areas and keep an eye out for our alerts on these issues as we get more information. So firstly, on the very topical issue that is, of course, remote working, a key question that is arising at the moment is whether the government will announce measures in the forthcoming budget to encourage it. The government does hope that remote working will aid them in achieving certain social objectives, such as balanced regional development, reducing pollution due to less commuting, improving quality of life, and alleviate accommodation pressures in urban areas. In a recent paper prepared by the Tax Strategy Group within the Department of Finance, they did look at what measures the government could implement from a tax relief perspective to encourage remote working. One interesting statistic I took from the report is that in a recent survey, workers indicated that they would like some form of remote working as part of their working week going forward. So this doesn't actually raise the question of whether any intervention is in fact required to incentivize workers to take up remote working. While employees may incur additional costs in working remotely, such as equipment, increased utility costs, etc., it could also be argued by working remotely for at least some portion of the week, they are saving on commuting costs, not to mention less time spent commuting and the benefits that would bring from a work-life balance perspective. From an employer perspective, while they may incur additional expenditure ensuring employees have the necessary equipment to allow for more remote working, it does provide benefits to them in that they will have access to a wider talent pool, and offering remote working may be a key retention tool for their existing employees as well. In addition to that, they can also potentially, if they require reduced blueprint, they potentially save on costs and reduce office space as well. And also they can take deductions with respect to the additional expenditure they incur to facilitate remote working, either in the form of an expense deduction for expenses that are revenue in nature or capital allowances on items such as IT equipment and office furniture in their corporation tax computations. On top of all this, on a more, broader perspective, a question of fairness does also rise with respect to any incentives for remote working, in that should employees actually get tax relief to work remotely, while those who cannot don't get any additional tax relief? And also, would any incentives given to employers to incentivize remote working effectively result in a subsidy being granted to companies for costs that they should ultimately cover? Given the assessment of the Tax Strategy Group, any measure that would be announced in the forthcoming budget may not be as favourable as we would initially hoped for. And also, I suppose there's a broader subject in terms of recognition of public sector workers and the work that they did during the pandemic. I suppose the government has to balance, being fair to cross sectors, across all sectors. So, I would say in the next forthcoming budget, I don't think the release will be as favourable as we initially would have hoped for. So now next on to gender pay gap reporting. As many of you will be aware, legislation has now been enacted in this area, and in its simplest, gender pay gap reporting is the difference between the average wages of men and women, regardless of their seniority. It will impact public and private sector employers with more than 250 employees initially, but it will be gradually reduced to 150 and then 50 employees over the coming years. The mechanics of when and how the information will need to be reported is yet to be published. However, the regulations are due to be enforced by the end of this year, and we would expect the legislation to apply from 2022 onwards. While we would expect this to be a challenge for many employers, especially in the initial years of its implementation, so now is an ideal time for employers to familiarise themselves with the categories of information they will need to report on, get the payroll data ready, and even possibly rectify pay gaps ahead of the reporting deadlines. Now, in relation to pension auto-enrollment, the government intended to introduce this by 2022. However, given the challenges brought on by COVID, it will come as no surprise to any of us that the 2022 go-live date is expected to be delayed until at least 2023. While the government's economic recovery plan announced earlier this year outlined a recommitment to auto-enrollment, the timing of these changes are currently being considered, and it's expected that a phased introduction of the system may be more appropriate in light of the current circumstances and pressures employers face. And now finally onto statutory sick pay. The government has announced earlier this year that they intend to introduce such a scheme in Ireland. This will be phased in over a 4-year period, starting with 3 days per year in 2022, rising to 5 days payable in 2023. 7 days payable in 2024, and eventually employers will have to cover the cost of 10 sick days per year in 2025. It's been phased in to help employers, particularly small businesses, to plan ahead and manage the additional cost, which is at present the employer will be obliged to pay for each statutory sick pay up to 7% of their employee's normal wage, subject to a daily cap of €110. Now I'll pass on to Andrew, who will run through revenue compliance interventions.
Thanks, Michael. I'm going to spend a couple of minutes discussing revenue interventions. First, we'll take a look at the planned update to the revenue code of practice expected in early 2022. We'll then look at trends in revenue interventions. These are trends that we've taken a look at the revenue annual report for the last couple of years, and there's some interesting movements there. Next, we'll look at what's new in a 2021 revenue audit. So for many people in the room actually probably have never been involved in a revenue audit, and others won't have been involved in revenue audits over the last couple of years. So we'll look at what's new in a 2021 audit against what would have been in place, say, 5-10 years ago. Again, the next bit we'll look at is what to expect in a current audit. So what's the step plan? What's the procedures in place for 2021 audits? And finally, we'll look at some common employment tax issues. Common employment tax audit issues that we see coming up again and again. So first, with the new code of practice, it's expected in early 2022, and consultations are still ongoing. It's replacing the current code, which normally we see the code of practice being updated every 2 or 3 years, and the last code of practice came into effect in October 2019. So it's kind of on track. It makes sense that we'd see a new code in early 2022. And the difference this time, last time there was a reasonable number of changes, mainly brought on by employment taxes, by the introduction of POI modernization. But in the 2022 code, we're expecting to see a significant number of changes implemented, and so a lot more than that we've seen in the last couple of codes, which have generally been kind of incremental changes here and there. The main change that I want to flag today is in relation to aspect queries. So aspect queries will be no more. They're going to be replaced by risk reviews. And the difference, so risk reviews at the moment with aspect queries, when you receive them in the footnotes or on the towards the end of it, it will note that it's not a revenue audit, and that you still have the opportunity to make an unprompted qualifying disclosure. And that's going to change. And if the risk review is as soon as the risk review has been received, it will now be a prompted disclosure that you will be making if you need to make a disclosure. And so with that, penalties are significantly higher. In some cases, penalties, will go from, we'll say, 3% as up to 10%, and higher than that again in other circumstances. And with that, there's an increased risk of publication. And so there's always a risk of publication if the penalty goes above 15%. And so that's one that will have to be managed carefully with the new risk reviews replacing aspect queries. Now looking at trends in revenue interventions. So audits, including investigations, we'll look at first. And the first one, the first thing I want to draw your attention to here is the solid purple line going across the screen. And you'll see that that's reduced. So in 2018, there was about 4,700 revenue audits. And that's reduced steadily down to 3,000 in 2019 and down to about 1,500 in 2020. Now, the reduction to 1,500 in 2020 is not a shocker, and it kind of makes sense given COVID and given that audits would have historically been a very in-person intervention. So the fact that they did significantly in 2020 kind of makes sense. But there's been I suppose a steady reduction in audits. They're expensive interventions to engage in, and it's so I suppose what I'd say is I wouldn't expect revenue to go back up to the 2018 levels or higher levels that we've seen in the past. The other thing I want to draw your attention to here is the yield. So the light purple block shows the yield, and in 2018 it was 53, nearly 54,000. That jumped significantly in 2019 up to 73,000 and up to 85,000. So on average now in 2020, revenue are yielding 85,000 on an audit, which is a substantial amount of money. So I think it probably points to a couple of things. One would be the general increase in the economy, but the second is that wouldn't explain a lot of it. The second is it probably points to revenue audit selection being improved. So as revenue get more and more sources of information and are pulling together their audit criteria, it looks to me like the audit selection is getting far more targeted and far less random. If we look at non-audit interventions, you'll see that again, if we focus on the solid line going across the screen, that's the total number of non-audit interventions, and you'll see that 2020 has increased. So while COVID explained a reduction in audits, non-audit interventions are up. And so revenue have been busy and have been very active in non-audit interventions. And to be fair, as Michael mentioned, a lot of those non-audit interventions have been focused on employment taxes around the wage subsidy schemes. While the number of interventions are up, the yield is also up. So in the table below, you'll see the average yield per non-audit, and that's increased. Now it's much more modest levels for non-audit interventions, and it's up from an average of about €550 up to just over €600. But it's still up, and it's worth remembering as well that non-audit interventions includes all non-audit interventions, including, we'll say, non-risk targeted ones, like letters going out the door that typically yield very low amounts, averaging about €20. So there's a whole mixed bag in there, but the yield on average is up, even though the number of audit interventions is up. If we then move and look at a 2021 audit, and we look at what's new in a 2021 audit. So the first thing I'm going to draw your attention to is extensive data requests. So if we go back 5-10 years, the audit, there was no e-audit involved, so it was typically a meeting, and then revenue would request certain paper records to review, and they typically focus on one period, and if they were satisfied with that, they would move on, and if they found issues with that, they'd explore that, and then that you would generally get to a conclusion of the audit. Now it's now revenue are requesting full data for the full period of the audit. So in employment taxes term, you're looking at data across payroll, expenses, banking, and full purchase ledger is normal. In addition to that, in the last couple of years, we're seeing new Appendix 1 presentation requests as well. And so these are detailed presentation looking for a good lot of general information on the business, and then a good lot of specific information on the tax head, how that's managed, what processes and what controls are in place to manage that tax head. And so again, it's a substantial new ask. With that, the middle point here is the pre-audit data meetings. So with all the information being requested, Revenue are fine. Revenue have historically found that the request wasn't clear enough, and the information they ended up getting was not what they were expecting. So to avoid that and to try and make sure that everybody is aligned, we've got these pre-audit data meetings. So it's a meeting in advance of the audit to discuss finance, payroll, and HR issues. And a key point here is that it doesn't commence the audit. So the audit will only commence on the audit meeting day, and so it doesn't commence the audit, and therefore it doesn't preclude you from making a prompt disclosure after that meeting has happened. And the other piece we're seeing is the audit extended to non-audit. So with all this significant data requests going on, we're seeing these e-audit requests. Again, this is only in the last about 3 years being extended across to non-audit interventions such as profile interviews, aspect queries, and verification checks. So again, historically, an aspect query would have requested a couple of, I suppose, pieces of information. A brief paragraph would have covered off on, and then maybe a sample. Whereas now revenue are often looking for significant amounts of information. And the last one that's not there that Claire mentioned earlier is real-time audits. So we're starting to see them only this year. So on the back of PAY modernization, revenue now have information on a month-by-month basis. And so we're starting to see audits that run for the year up until, we'll say, August 2021. So that's new as well. Then if we look at overall what to expect with a 2021 audit, I'm not going to go through all of these points, but starts with the audit letter. The first one I'll emphasize is the audit date. So the audit date the audit letter will typically give you 3 weeks before the audit's due to commence. That's normally agreeable to be amended. So it normally, if you pick up the phone to revenue, they're agreeable to push it down to give you a more realistic time frame to do a proper review and get ready. If that's not available, there is, we have seen a harder line be taken in certain circumstances, and there is provisions in the code of practice where you can formally extend it for 60 days. And so that can be looked at if revenue are not agreeable. The next one, engage all the stakeholders internally, your tax, HR, finance, and IT, and engage any external support that you may require. The pre-audit meeting I discussed earlier. The fifth item here is audit preparation. It's probably the biggest item, or it probably should be the biggest item. So there's a large amount of preparation to be done in terms of getting the files ready out of the system, and then reviewing those files and making sure that you're comfortable with what's being provided, and that you've identified any issues that may need to be disclosed. Some of those will only arise from a trawl of those files, whereas other ones might be known issues that you knew or come across that may need to be looked at, bottomed out on, and disclosed. The audit then will kick off. Typically, you'll see an audit presentation. You will make a disclosure if one is needed, and then at the end of the audit meeting, you'll upload the files to revenue, and then revenue will go and do their work off-site. So that's a change in current audits. Hopefully you get to number 7 and get the audit concluded, and that's great. And then the last point that I really stress is a post-audit review. So what you risk doing is going, oh, phew, everything is perfect, everything is great, the audit is concluded, and it is. But you've probably found some issues that you needed to disclose on. You probably found a couple of other issues where you identified control weaknesses or other issues that didn't result in a disclosure, but stuff that you need to address. And so the post-audit review and addressing all those issues is very important. And lastly, we'll come on to common issues that we see in employment tax audits. The first one won't be a shock to many. It's professional subscriptions, and we see it coming up again and again and again. It's still the hobby horse in audits. Employed versus self-employed is another area that comes up frequently, and there's certain industries where it's particularly an issue. But in all industries, what we'll often come across is, we'll say, a contractor in IT. They came in on a project, say 2 or 3 years ago, 6 weeks, 12 weeks, something like that. They were quite good, quite useful at their job, and they've been kept on brought in on another contract, and another contract, another contract, and now they have their own desk, and they tend to do whatever's needed. but they're still invoicing on a monthly basis rather than going on to payroll. And so it's people like that all businesses may need to take a look at. And pension contributions is a very easy one for revenue to take a look at, and they do. Termination payments, there's normally only a couple in any given year, and it's worth just in preparation for an audit making sure that the comps are right and that advice is taken. Any other non-taxed item that's going through payroll. So if it's not being taxed and it's going through payroll, you want to make sure that you're comfortable with exactly what's happening there. And the last one I'll flag is a broad category of private expenses and taxable benefits. So taxis to and from work is a hobby horse of revenues. We see that coming up a lot. Significant entertainment costs. Entertainment costs that are reasonable, available to all, and infrequent are generally permissible. We've seen revenue attack this in some recent audits, and it's one to just keep an eye on. Mileage is one. It's a difficult one to keep track on. The rate starts low, it goes high, and then goes low again, and to keep track on everyone's mileage and a good control on it is difficult. BIK on company cars, making sure you've got the right rates in place. And keeping track on the different mileage there as well. And the last one is use of company credit cards, particularly credit cards that are cleared automatically on a monthly basis, to make sure that there's proper controls in place to document and receipt all the different items on a periodic basis. So I'll now pass you across to Claire, who'll take us through some key takeaways.
Thanks, Andrew and Michael, for your presentations, which have been really helpful and informative. I think it's clear there's certainly been a renewed focus more generally on employment taxes in 2021. And I guess with the government undoubtedly faced with budget deficits as a result of the pandemic, I'm sure you'll both agree this heightened revenue focus is likely to continue in a post-COVID environment. So I think with this in mind, my key takeaways from our session today are: number one, PAYE compliance is not getting any easier and is becoming more costly when mistakes are made. And it's clear from the stats Andrew shared earlier, revenue have targeted and generated additional revenue from PAYE interventions in the years leading up to and since the introduction of real-time reporting. Number two, given the increased revenue scrutiny over employers' adherence to the real-time reporting requirements, this emphasised the importance of having robust PAYE controls so employers can recognise when PAYE obligations arise and also ensure PAYE is accounted for correctly in line with the PAYE regulations and real-time reporting requirements. And thirdly, there's certainly been a number of updates since our last webinar. For example, as noted by Michael, many of the temporary COVID concessions introduced at the early stages of the pandemic have now been withdrawn. So I guess to mitigate compliance risk, it's important for employers to now assess whether they're continuing to rely on COVID concessions which are no longer available in practice. And finally, as noted by Andrew and Michael earlier, further employment tax updates are expected in Budget 2022 and beyond. So be sure to register for our Budget 2022 tax briefing on the 13th of October, and of course our future Lunch and Learn sessions in the area to bring you up to date on the latest developments in real time. So moving on now to our Q&A session. I am of course conscious of your time, so hopefully I'll be able to give people back a couple of minutes before the end of their lunch. So I'm going to settle maybe on just one or two questions, if you don't mind, which hopefully draws together some of the various questions coming in today. Michael, I might start with you first. Naturally, some budget related questions coming in today. So if I can focus your attention on remote working at the minute, a topic which is certainly generating a lot of attention in the lead up to the budget. You mentioned the government releasing their findings on the current tax arrangements, but have they given any indication at all, I suppose, on what options or perhaps enhancements they might be considering in this area in advance of Budget 2022?
Yeah, Claire, in that tax strategy group paper, they did suggest, two key suggestions that they popped out for me was, number one, that they they were suggesting that instead of employees calculating what portion of their utilities and their broadband costs they could claim a tax deductible per DM rate of, I think they suggested 150 per day. And any of us who've actually tried to work out what portion of our light and heat we can claim as a deduction will kind of realise that it's a lot of work for not a whole lot of benefits. So this might be a simplification measure instead of going through the mechanics of working that out. Another suggestion they potentially suggested was in giving an increased tax credit for remote workers. And a kind of key advantage of that is that it's quite easy to implement rather than trying to come up with new schemes and try and work out mechanics of new schemes like that. But I suppose they were more suggesting, I would say, that the group were just merely, I'd say they were making suggestions, but I didn't get the sense that they were strongly advocating for them, given what I was discussing earlier about whether or not there's really a need to incentivize something that people seem to want to do anyway. So we remains to be seen of whether or not these suggestions will be taken up by the government. I did note that the Varadkar yesterday did mention that there might be something in the budget for remote working, so we hope to see something. But I think that tax strategy group did kind of certainly reduce my expectations on anything meaningful happening.
Thanks, Michael. Yeah, I think there's certainly a lot to consider there as well, and hopefully Budget 2022 delivers from an employer and employee perspective. So it will be interesting to see what's finally agreed upon and announced over the coming week. Yeah. Andrew, finishing up with you, I know Michael spoke earlier about gender pay gap reporting, but I might direct this one to you if you don't mind, given I know you've been busy in this area for quite some time. So in short, when do we expect the new legislation to take effect, and what do we expect the actual impact of the new rules will mean for employers in practice?
Yeah, Claire, that's a tricky one to get to. So the legislation, it's been flagged that the regulation will be received towards the end of the year, and that the legislation will kick in then in 2022, as Michael set out. I'm just a skeptic on those dates because I've been working in this area for about the last 4 or 5 years, and during all that time there was legislation in place, and it was always promised that it was the next session of it all, the next session of it all, this session of it all, and it was only in July that it was finally passed. So I'm a little bit skeptical on our ability to meet the timelines that are set out. But in theory, it's towards the end of this year and to kick in from next year. In terms of impact, I'd say I've sort of flagged 2 impacts. One is the impact on employers is quite heavy. There's quite a lot in doing a gender pay review. And indeed, the previous ones I would have done would have been based on the UK rules, and the Irish legislation goes further than that. There's a couple of additional statistical points, and there's a couple of additional explaining points to be done. So you need to understand and be able to explain what you're doing in relation to your gender pay gap review. And then the other impact that I sort of flag is will it make any impact? Will it make any difference? And I would have been somewhat skeptical previously, but having looked at the UK trending for the last couple of years, they've had it in since 2017, and in any industry I've looked at, the pay gap is reducing, so it is having an impact year on year. Yeah, so hopefully that's useful.
Great, thanks, Andrew. And I guess the point I made earlier, just in relation to having good quality payroll data as well for real time, will equally apply, Andrew, in the context of gender pay gap reporting legislation.
Correct. Yeah, it's a heavy amount of information needed there.
Yeah. Okay, so I think we'll wrap it at that. Thank you again to our speakers today, Michael and Andrew, certainly given us a lot to think about. We do hope you found the session useful and were able to pick up on some insights which will help you in your business and of course your future revenue interactions. If you have any questions in relation to any of the matters discussed today, please visit our kpmg.ie tax webpage for regular updates, or please feel free to contact me, the team here today, Michael and Andrew, or your usual KPMG contact. Thank you again for joining us today, and on behalf of KPMG, we do hope you have a lovely afternoon. Thank you again.